Ever wondered how the investing maestro, Warren Buffett, zeroes in on a stock's real value? Buckle up, because today, I'm lifting the veil on his magic formula. In this episode, not only will I decode Buffett's method for calculating a stock's intrinsic value, but you'll also get a hands-on example to solidify your understanding in the latter part. So, stay tuned till the end. Picture a business as a money-printing machine. The key is to determine how much you'd willingly pay today for this machine, based on the amount of cash it promises to churn out annually. Once you pinpoint the amount you'd invest to own the entire business, considering its yearly cash output, you'll have a benchmark, the intrinsic value. Now, compare this to the company's market capitalization, which, for the uninitiated, is the total stock market value of a company, to see if the stock is undervalued or overvalued. Got it? Or does it sound a bit fuzzy? No worries. Let's hear it straight from the Oracle of Omaha. Grab a notepad because you'll want to take notes. This is a comprehensive clip, but trust me, every second is gold.
Is how do you find intrinsic value in a company?
Well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
When diving into the world of investments, bonds stand out due to their predictability, their returns spelled out for you. Every interest payment, every ounce of the principal is clearly defined, but switch over to stocks, and it's a different ballgame. Unlike bonds, stocks don't wear their future on their sleeve. They require an analyst's discerning eye to forecast future cash flows. Your challenge: turn that stock certificate into a predictable bond, forecasting its potential future payouts. Consider purchasing a new machine for manufacturing carpets. You're projecting the returns it will offer, right? The same logic applies when buying a huge business like Coca-Cola. If Coca-Cola's market price stands at a staggering $115 billion, the real question is, would you buy it? And more importantly, should you? The essence is to determine if the potential future cash inflows are worth the present investment. No matter the asset, be it a farm, an apartment building, or oil reserves, it's a game of cash. You're putting down money today in hopes of more in the future. The underlying question always revolves around the amount, the timeline, and the certainty of those returns. Buffett's methodology is not just about numbers, it's about value. If Berkshire, for instance, has a market cap of $105 billion, can it yield enough, soon enough, for the investment to make sense? This approach is known as the discounted cash flow analysis, or, as Buffett eloquently puts it, the discounted present value of all future cash flows. Sound complicated? Stay with me, as we're about to break it all down. Picture this. You've got your eyes on a business and you're ready to make a move. First, you buy. Then, you hold on to this business for a decade, reaping its juicy profits year after year. And finally, after 10 rewarding years, you sell it for a hefty sum. Sounds ideal, right? But the million-dollar question looms: what's the right price to buy this business at today? Before diving deep into figures, let's break down a term you'll often hear: free cash flow. In the simplest of terms, think of it as the cash left in the till after the day is done. It's the money the business makes, minus its expenses. How do you calculate it? Focus on two main figures from the cash flow statement: the cash flow from operations and capital expenditure, often referred to as property, plant, and equipment expenses. But there's a twist. For precision, we'd ideally subtract only the capital expenses linked to maintaining the business, not growing it. Yet, most companies don't readily share this breakdown. No worries though. For this guide, we're sticking to the overall free cash flow, a conservative yet slightly less accurate choice. Next on the agenda, gauging how much this money-making machine will grow over the next decade. Now, tread carefully. This growth rate isn't a number you pick out of thin air. The rate you choose drastically influences your valuation outcome. Dreamy, unrealistic expectations. They can lead you astray. Thinking a company will skyrocket 200% year after year for a decade is pure fantasy. Even projecting a 25% annual growth is ambitious. Historical perspective. Review the past decade. How swiftly has this company expanded its free cash flow and equity? Industry benchmarking. Compare. What growth rates are rival companies in the same industry pulling off? Looking ahead, go beyond numbers. Dive into the company's future growth catalysts. Understand what'll drive their cash flows forward. Imagine Tesla as our example. With 2 new factories poised to commence operations within the next 5 years, a crucial question arises. How will these factories influence vehicle deliveries? And how will that, in turn, impact Tesla's free cash flow given their current profit margins? Historical analysis. What has the company's growth been like over the past decade? Industry benchmarking. How are rival companies faring in the same sector? Future predictions. What future ventures or projects, like Tesla's factories, might influence the company's growth? For our case, we'll hypothesize a growth rate of 10% annually. Using the 10% growth rate, we can estimate the next decade's free cash flow. Simply multiply the prior year's cash flow by 1.1 to account for the 10% increase. Imagine selling the business after 10 years. The selling price, or the terminal value, can be derived by examining the business's average selling multiple over the past 5 years. For this example, let's use a high multiple of 25.5, though this might not be accurate for all businesses. By multiplying the 10th year's free cash flow with this multiple, we obtain the terminal value. Warren Buffett emphasizes the importance of timely cash delivery. $1 now has more value than $1 in 5 years due to the potential for investment and growth. This is where discounting comes into play. Assuming we target 15% annual returns, we discount the future cash flows by this percentage. As time progresses, even with a cash flow growth of 10%, the present value decreases due to opportunity costs. Once the future cash flows and terminal value are discounted, summing them up gives the business's intrinsic value. If our assumptions hold, 10% growth rate, selling the business at 25.5 times the free cash flow, and targeting 15% returns. The intrinsic value for this example stands at $595.97 billion. If the current market cap is less than this intrinsic value, purchasing the business at its current stock market rate would likely yield the targeted 15% returns. After determining the intrinsic value of a business, it's essential to consider the unpredictability of the future. All calculations done up to this point are predictive and subject to uncertainties. Compensate for potential errors. Even with the most rigorous analysis, errors can arise due to unforeseen events or miscalculations. A margin of safety compensates for these inaccuracies. Protect your investment. By purchasing a business below its calculated intrinsic value, the investor is cushioned from potential downturns, thus de-risking their investment. Enhanced returns. If predictions turn out accurate, the margin of safety can lead to returns that exceed the targeted 15% annually. Deciding on the margin of safety, the size of the margin can vary. Some investors might opt for 20%, while others might choose 50%. This flexibility allows one to adjust based on their risk tolerance and confidence in their predictions. In the current economic landscape, many businesses might trade above their intrinsic value. Yet, opportunities can still emerge, and diligent investors can find undervalued gems. Using Warren Buffett's approach offers a disciplined way to evaluate investments. If you found value in this content, please help us grow. Subscribe to the channel, hit the like button, share with your friends, and leave your comments below. Your engagement makes all the difference and helps us continue producing quality content for you. Join our community now